Well, hello and welcome back to Convera's monthly webinar series, where we provide an update on the latest macro and market trends, as we're expecting quite a few attendees from several countries today. While we wait a little bit longer for others to join, I'll just quickly run through some housekeeping before we get started. So first, you'll notice that your lines are muted and your cameras are turned off. Ours will also be turned off during the presentation, just to minimize any technical disruptions, but also to allow you as the audience to focus more on the presentation deck. We'll be posting the link to the recording on our website, where you'll be able to find the report that we're presenting today, but also other research insights from our team, like the FX weekly report and the daily market update. Now, for today's webinar, as you can see, our speakers include myself. I'm Boris, the global macro strategist for Convera, based in Vienna, Austria. And we have Ruta joining us as well, our G10 FX strategist based in the UK. In terms of the agenda, I'll be providing a quick but comprehensive overview of the global economic outlook. I'll be highlighting the most important key themes dominating the macro space right now, and factors that have been influencing financial markets over the last couple of weeks. I'll then hand over to Ruta, who will kickstart the currency market overview and show us some forecast on our main currencies. So onto the webinar itself, I think it would be fair to say that the main takeaway from the FX side is that the US dollar continues to dominate the landscape. And this despite volatility on currency markets remaining extremely suppressed. So US data just keeps surprising to the upside, and with markets pushing out their expectations on the first rate cut from the Federal Reserve, the US dollar has been supported quite nicely in March. And this translates into a slightly lower euro-dollar rate and a slightly lower pound-dollar exchange rate, even though both currencies remain incredibly range-bound due to the factors Ruta and I will be discussing. And one fact and one stat, I think, to summarize this development quite nicely, is that despite being up against 80% of global currencies, the US dollar has only gained around 3% in the first 3 months of the year. So the dollar is supported by this divergence of policy in favor of the Federal Reserve, but the gain has been limited by the suppressed levels of volatility. And I think with that in mind, we can already jump into the macro section to explore a bit what has really impacted financial markets in recent weeks. And for us, I think it is all about monetary policy, because monetary policy has clearly been an overarching theme driving price action. As we can see in this chart right here, the share of central banks cutting interest rates has already risen to its pre-pandemic average of around 25%. And we can see that November last year had really been the first month where rate cuts globally surpassed rate hikes. And this is coincidentally also the month when global inflation fell below 4%, again, for the first time since the pandemic surge. And which is why, retrospectively, we also say that November marked a new macro regime that effectively ended the 2.5-year hiking cycle that started in early 2021. So investors, as we wrote here, became more comfortable pricing in the turn of global monetary policy to something more accommodative, more supportive of markets. And central banks in emerging markets were, of course, the first ones to start their easing cycle in countries like Mexico, Brazil, Hungary, Poland. But going forward and going into the year, the focus really shifted to the important G10 central banks, with the Fed at the top. And the main question was, when will they start easing monetary policy? Because that is all that mattered for financial markets. And I would agree that, and I would argue that the back and forth in pricing this eventual start of the easing cycle of the Bank of England, of the European Central Bank, of the Federal Reserve, has influenced markets more than any single topic otherwise. And we can clearly see this in our second theme, which is that equity markets have rallied to record highs multiple times this year already. And as I mentioned, this comes despite the expected rate cut from the Fed for this year, going down from 7 rate cuts being priced in at the beginning of the year to now markets pricing in less than 3 rate cuts from the Fed. And this would have been, in theory at least, something negative for risk assets, negative for the pound, and something positive for the US dollar. And it has been somewhat because the US dollar has appreciated by a small margin this year. But investors, so far at least this year, have really focused more on the positive fact that the global policy cycle has already turned dovish. It has turned more accommodative, and have really negated the fact that the Fed or the ECB will cut rates a bit less aggressive this year than otherwise thought. Because in the end, what markets really care about is that the big central banks will eventually have to cut interest rates. And this is the mantra that is dominating markets right now, and something that equity investors focused on in the first couple of weeks of 2024. And this, I think, explains also why, first of all, equity markets in Europe and in the US rose to new all-time highs 8 consecutive weeks this year, and why FX volatility sits near 10-year lows as well. Now, the big risk for us ahead lies really in markets underestimating inflation and economic growth, because both or kind of one of those variables surprising to the upside would really mean that the easing cycle gets cut short, or that central banks like the Fed don't start easing policy at all this year. And we've seen inflation in the US turn positive again, and global growth starting to pick up again. So this pro-cyclical recession of the manufacturing sector, of the global trade, they are over, and Europe is starting to recover slowly. And the recent rise in commodity prices as well, and inflation expectations, kind of just adds to the fact that inflation volatility will be higher over the next couple of years than it was in the previous 10 to 20 years. Just looking at, for example, oil prices, they're up 16% year to date. Copper is up 11%. Gold is at an all-time high. Silver is near 20-year highs. So this all adds to the fact of, okay, inflation is probably here to stay. And this means that central banks will most likely cut less than initially expected. So inflation will continue to matter, not only for the next couple of months, but in our opinion, for the years ahead. And I think this puts us nicely into our next segment as well, which is the theme in focus for the month. And here we post a question, not only where is volatility, but better put, where can volatility come from in the months ahead? Because the first question got an answer in our previous couple of slides, namely that inflation has peaked at the end of last year, and the tightening cycle of global central banks ended as well. And this has been responsible for volatility getting to these 10-year lows. But the second part of the volatility puzzle, I think, has really been also the synchronization of policy rate expectations. Because up until 1 or 2 weeks ago, the expected policy path of most central banks, like the Fed, the Bank of England, the ECB, was completely the same. Markets had been pricing in the same policy path for these central banks. And this despite their respective economies being vastly different in terms of their position in the business cycle and their growth outlooks. And this is now starting to change, as I said, because as economies continue to diverge, so I think will monetary policy and the market's expected future policy path change as well. And this is why investors now expect the Fed to cut 2 times this year versus 4 cuts being priced in for the ECB and 3 cuts for the Bank of England. However, I think one main thesis of ours here is as well that the eventual divergence of this policy between the central banks will move markets directionally, but it wouldn't be enough to meaningfully push inflation rates higher, because we have now effectively entered this dovish monetary policy regime, which is characterized by these big central banks' bias to cut interest rates. And in this regime, only a renewed spike in economic growth, or in this case, inflation, or thirdly, an external shock like the US elections in November, like geopolitical developments in the Middle East, could meaningfully alter the volatility picture from here on. So again, given this setup going into April, I think it would be fair to say or to ask, is there something coming up that could meaningfully alter this volatility picture? And we would have to say not really, because we have the rate decisions in the Eurozone, in Australia, and also in Asia, in China and Japan, of which none will be particularly market moving on their own. And from a global macro perspective, also, only top-tier US data has the potential to alter the volatility picture. But given that the important ISM surveys and the jobs report have been published last week, it is really little left to induce volatility going into the next couple of weeks. This will be different in May and June, as the first G10 central banks are starting to gear up for the first rate cuts in this cycle. But as I said, as of now, in the next couple of weeks, we are expecting volatility to be suppressed at current levels. One thing that we're still watching out for is the main event of the week, but also of the month, is the rate decision from the European Central Bank. And this is, in my opinion, our risk event, because even though we markets economists don't expect policy makers to change the interest rate on Thursday, any communication regarding future cuts in June or sooner or later and onwards will be closely watched. We have been quite outspoken about our call of Eurozone inflation falling below the 2% target in the months ahead, which I think should give the ECB more room to cut rates than, for example, central banks like the Federal Reserve or the Bank of England. However, as we said, how much easing actually gets delivered is still on the cards, and it will, of course, depend on the inflation picture, but also on the incoming macro data. I think with that in mind, I would like to hand over to Ruta for some insights into the recent FX trends.
Thank you, Boris, for setting the scene with a great update on the recent macro trends. So to kick off the FX update, let's first start by discussing the recent volatility trends across the G10 space. So as Boris mentioned, over the past quarter has presented us with a remarkable trend of subdued realized FX volatility, which, as he mentioned, can be attributed largely to the absence of significant adjustments in policy rates by the major G3 central banks. While other markets such as commodities have experienced historical price rallies, the FX market has remained notably subdued throughout Q1 of this year, and indications suggest that this trend is poised to persist for the foreseeable future. Examining the data in front of you, we observe that realized volatility over the past 30 days has remained muted across the board. So trading ranges, which are measured as a ratio between bid high and low values, for the top 10 globally most traded currencies have been largely contained within a 4% margin. Taking a closer look, we find that Kiwi dollar has exhibited the highest realized volatility, with a deviation of 3.8% from bid high to low over the past 30 days. Following closely, dollar yen emerges as the second most volatile currency during this period, with a deviation of 3.7%, attributed in part to the Bank of Japan's decision to raise its key short-term interest rate to zero territory for the first time since 2007. So central bank-induced FX volatility has also been seen across Swiss franc crosses. Dollar franc, for instance, has experienced swings close to 8% in 2024, triggered by the Swiss National Bank's unprecedented rate cut, marking the initiation of the monetary policy easing cycle among the G10 central banks. Apart from the sporadic policy-induced spikes, the FX market continues to remain remarkably quiet. A case in point is sterling dollar, which has fluctuated within a narrow 3% range year to date. In fact, sterling dollar has spent 50% of its time oscillating within an exceptionally tight range of 126 to 127, underscoring the unprecedented calmness prevailing in the market. Moving on to the next slide, it's crucial to note that despite the pockets of sporadic policy-induced action, FX volatility remains exceptionally low by historical standards. For instance, the 1-month euro-dollar realized volatility is currently at near 29-month lows, reflecting a prolonged period of subdued price movements. Similarly, sterling dollar cross volatility hovers at 2-year low, and sterling euro volatility is a near 32 low when measured on a close-to-close basis. Even with the recent monetary policy adjustments mentioned earlier, volatility for currencies like the Swiss franc and the yen remains below historic norms. As an example, despite the BOJ's decision to end its ultra-low interest rate regime, volatility in the dollar-yen pair has reverted back to multi-month lows. This is despite the threats given the recent warnings from the BOJ officials regarding the potential of central bank intervention. Turning our attention to implied volatility next, which is an indicator of market perceived future volatility, we do find that the overall implied volatility still remains relatively unchanged compared to March. Market participants anticipate the current regime to persist, with the implied vols hovering near multi-month lows across the board. However, there is one notable exception. Dollar CAD 1-month options are at their highest level since the beginning of January. This comes in light of last Friday's unexpected labor market report from Canada, which revealed a surge in the unemployment rate to 6.1%, reaching 2-year highs. The economy is visibly feeling the strain of a historically high interest rate environment, leading us to anticipate increased volatility in the coming months across this pair, particularly surrounding the Bank of Canada's rate decision scheduled for tomorrow. So moving on to the next slide, I would then like to spend the next couple of minutes evaluating the relative positioning of the currency pairs to help gauge their fair value versus their respective short and long-term moving averages. When it comes to the price levels, there have been some intriguing developments in the currency markets over the course of March, particularly concerning the Japanese yen. As we observe, the yen continues to hold its position at the top of the table, trading over 2% below its year-to-date average against the US dollar. Remarkably, USD Japanese yen is currently reaching heights not seen in the past 34 years, hovering above the 150 mark as the Bank of Japan concluded its historical move of ending the world's last negative rates. This surge places the pair approximately 25% above its 5-year average. And despite BOJ rates lingering around zero, the yen remains a favored funding currency, leading to its widespread weakness against other major currencies, not just the US dollar. Shifting our focus, although not provided in the table in front of you, the Swiss franc has witnessed a notable appreciation against only 16% of its global peers over the course of Q1, marking its weakest 3-month performance since 2007. It also currently ranks as the second worst performing major currency year to date, having depreciated by over 8% against the US dollar. Similarly, the Kiwi dollar has experienced a parallel depreciation of over 2% below its year-to-date average, attributed to the weakness of the New Zealand dollar on the back of signs of faltering economic growth. Overall, as you can see, the US dollar remains king in this subdued volatility environment. If we go to the next slide, for the next couple of minutes, let's dive into the realms of technical analysis, focusing more on the strategic short-term movements. And here I'll be dissecting the euro-dollar and dollar-CAD movements, shedding some light on key patterns and potential catalysts driving these fluctuations. So beginning with the euro-dollar chart on the left-hand side first, we observe a pattern of oscillation between 107 and 110 for almost every trading day but one over the course of 2024. As Boris mentioned, ECB's rate decision tomorrow may signal dovish sentiment ahead of the expected rate cut in June, which could momentarily pressure the euro towards the lower level of this 2024 range. However, we do think that any impact as of now is likely to be short-lived, as market expectations for additional easing have already been heavily priced in, with the swap implied probability of a June rate cut hovering around 90%. So a similar trend is also mirrored in the sterling dollar pair, where, as I mentioned, the pound dollar exchange rate has predominantly traded in the very tight 126, 127 level for 50% of Q1. Next, shifting our attention to dollar CAD, we observe an upward trending channel with 136 serving as a robust resistance level. Despite repeated attempts, the pair has struggled to sustainably breach this barrier for the past 5 months. And with the current spot positioning, it does appear that US bulls may be losing momentum as the pair continues to edge closer towards this level. The narrowing of this channel suggests an impeding breakout poised to occur either above or below this pattern. So tomorrow's release of US CPI data or the Bank of Canada's decision could serve as potential catalysts for such a breakout. As we transition to the final slide of this section, I'd next like to draw your attention to two factors that were in consideration throughout the month of April, be that the seasonality effects and speculative currency positioning. Let's first explore the impact of seasonality. And historically, April has exhibited strong seasonal trends, particularly for the sterling dollar pair, which has appreciated in 16 out of the last 20 years. This upward momentum is often driven by robust dividend repatriation flows towards month end. Similar patterns are also observed in euro-dollar and dollar-CAD pairs, where the US dollar tends to underperform against its counterparts on average during April. Additionally, the second factor worth considering is the current speculative positioning in the FX markets. The chart on the right-hand side illustrates that many currencies are currently positioned in a stretch territory against the US dollar, which could serve as a headwind for further appreciation in the near future. However, it's worth noting that the euro and New Zealand dollar are positioned more neutrally compared to their respective 10-year interquartile ranges, suggesting a more balanced outlook for these currencies. So overall, the FX market's subdued volatility, driven by the cautious stance of major central banks and sporadic policy interventions, presents both challenges and opportunities for the market participants. So as we navigate through this period of tranquility, it becomes imperative for us to remain vigilant and adaptable to the ever-evolving dynamics of the FX landscape. And with that, let's move on to the final section for my presentation today, which is the FX forecast scenarios. And let's dive a little bit deeper into what can we expect over the next 8 months for 3 of the most traded currency pairs. Focusing on the chart in front of you, the left-hand side shows the historical exchange rate of euro-dollar based on its average weekly closing prices. And on the right-hand side, we have a forecast fan chart, which shows a range of paths that the exchange rate could take based on the exchange rate fundamentals, as well as their respective future trajectories. As a reminder, these forecasts have been created in partnership with the Oxford Economics, using a behavioral long-term fair value equilibrium model, which incorporates a range of variables such as interest rates, growth, and inflation differentials. From the baseline, we then display one standard deviation above and below to provide a central scenario, which is the gray shaded area in the middle, and should account for over 68% of the expected future outcomes. So looking specifically at the euro-dollar pair and its forecast for the near future, there was a minor upward revision to the euro-dollar baseline for April, which simply reflects the latest price developments, given no major triggers. In our central scenario, we continue to expect euro-USD to broadly trade around its baseline of 109 by the end of 2024, and we anticipate stability in the range of 107 to 111. Considering upside and downside scenarios, one of the factors that could see the pair appreciate above 111 level could be a sharper than expected slackening in the US labor market, which would then cement the case for the Fed to cut policy rates in the first half of the year. As a result, the narrowing US Eurozone yield spreads would then reduce dollar's interest rate advantage, leading to dollar depreciation. And on the contrary, euro-dollar could potentially plunge below 107 and even edge towards parity if US inflation proves more stubborn than expected, to the point that the Fed delays cutting rates in 2024 altogether, while ECB eases policy rates as inflation is already within an arm's reach of its 2% target. While that's not our base case, we have been seeing some evidence of US inflation stubbornness, as 5 consecutive inflation prints came in hotter than expected, leading to market participants already delaying Fed policy rate cuts to July. However, options market currently imply only about 15% chance of a big enough drop in the euro-USD to take it down to parity from the current levels over the next 12 months. Moving on to the sterling dollar pair next. Compared to the March forecast, we again have raised up slightly our near-term baseline given the recent price moves, while leaving the longer-term forecast tail beyond mid-2025 unchanged. In our bear model, it shows that the sterling is heavily undervalued against the dollar, so our forecast assumes that sterling strengthens against the US dollar over the forecast period. However, this process will be gradual given relatively high levels of external debt and a wide current account deficit. For now, our near-term expectations are for sterling dollar to continue trading in a tight 400 pip range around the 127 level. Having said that, again, receding geopolitical risks as well as an improvement in China's global outlook could pose an upward surprise to our base case, fueling demand for riskier assets and thus boosting sterling demand. Equally, if we observe signs that UK is falling into a deeper recession, which we could potentially observe as soon as this Friday's report, worsening economic backdrop could suppress the pound and see sterling dollar trade below 125 or below. Finally, on dollar CAD, compared to the March forecast, our baseline remains unchanged as we continue to anticipate the pair to depreciate towards 132 level by year end. We hold the view that the Canadian dollar is currently undervalued relative to its fair value equilibrium, suggesting a long-term convergence towards the highs of 120s, obviously bearing any systematic shocks. Considering potential scenarios, tomorrow's BOC meeting could pose an upward risk to dollar CAD pair. As I mentioned, in Canada, inflation is already converging on target, while Friday's unemployment report revealed the domestic labor market slack is increasing. So while the Canada Central Bank remains wary for now, it obviously does not want to cause a recession. And there is now a sizable probability that the BOC could potentially open the door to a possible June rate cut during tomorrow's meeting. And under such circumstances, we expect CAD to underperform against the US dollar. On the flip side, if the BOC cuts in tandem with the Fed, but less aggressively than the US counterpart, tightening policy rate differentials could swing in the favor of the Canadian dollar, and we could see loonie appreciate to 133 and below against the greenback. On that note, thank you for listening to the FX update, and now I'll pass it back to Boris for the final remarks before we close today's webinar. Thank you.
Great. Thank you, Ruda, for that great currency update. I think we have 3 minutes left. So before we end the webinar, I would really like to make 2 quick last comments to help us make sure we're giving you the best experience and the best insights we can. We would really appreciate your feedback here. So on this slide, you can see the QR code. If you scan that with your phones, you can take the survey. It should only take less than a minute. It's just a couple of questions, but the survey will be open for the next 7 days. So if you don't have a chance now, it will also be available in the follow-up email with the recording of today's session. And once again, if you found this interesting, consider subscribing to our research on our website, where we also cover all the discussed topics of today in much greater detail for our readers on a daily and weekly basis. So with that in mind, thanks again for joining us today. Wishing you all the best and see you next time.